video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel, and today is finally FOMC day, right? We have actually reached the date for rate cuts. We can say with pretty much as much certainty as you could ever possibly have in markets that we will be seeing a 25 basis point cut, because that's what the bond market in aggregate has priced in here. And of course, it is the bond market that determines rates. So I'll be pretty shocked if we don't get a 25 basis point cut. Of course, it's a market, right? Anything and everything is on the table at all times, including a surprise 50 basis point cut or no cut at all. But on a balance of probabilities, it is silly, I think, to say anything other than 25 bips is what is coming today. Let me know in the comments if you want me to do a live stream tomorrow and a bit of a Q&A post FOMC. I'm not going to go live for the meeting. I just don't think there's any value in my time in doing that, or in your time either. For reasons I can't quite explain, I've become quite locked on to this whole interest rates and rate cut thing at the moment. I've become quite the proponent of beating the same drum over and over again and saying things like these rate cuts are probably not going to be that bullish for the stock market, and that whilst I'm calling for higher prices for 1, 2, even 3 cuts, right, I'm still making the case that these are cuts into a slowdown, and therefore we are probably going to see major tops this year and enter a recession. I think we're probably already in recession, and that's a big reason why these rate cuts are just not going to be as bullish as the majority of market participants currently believe. This article I've been writing on X is very nearly done here, okay? But I just wanted to pull up one chart from this, and that's this one right here, okay? Just to show you that I'm not just kind of saying things, like I really do mean it. This is the current survey, okay, for institutional base cases. And you can see at the hard right edge, 13% think a hard landing is on the table. 13% think a recession is coming. And the entire rest of the fund managers that were surveyed in this Bank of America fund manager index or fund manager survey have no landing or soft landing as their base case, okay? So I know people are tired because there has been a whole heap of perma-bears, doomsayers, permanent top callers, permanent recession callers, and all this kind of thing. But it is important to kind of look around and say, well, who is it that's been able to just non-stop doom post and just been on the wrong side of the market, right? Versus who has actually been able to demonstrate being long and strong in the stocks, right? Trading the cycles, sidestepping the drawdowns, being open to all possible outcomes, while simultaneously acknowledging that the market is not the economy. Right? And it's okay to say, well, I'm very bearish at the economy. The economy looks to be slowing down and continues to head into recession, whilst at the same time the markets continue to go high. Okay, so I know people are really kind of sick to death of hearing people cry recession, but as expected, I believe we have headed into a recession now, right? I believe these are cuts into a slowdown, and as expected, okay, we are now super one-sided. We've actually been one-sided for a while, but we are extremely one-sided right now. So if you're kind of sat there banging your head against the wall going, oh, not another recession caller guy, just know that it's actually highly contrarian to be expecting a recession soon, okay? And sentiment amongst these kind of hedge fund managers and that kind of thing is, I believe now, at complacency. Now, I'm going to play this clip, and hopefully I'm not going to get kind of copyright struck for this. Now, if I do, I'll have to edit this clip out, which means by the time you watch this video, this will either play, meaning it's fine and I'm allowed to use it, or there'll be a blank space here and we'll just skip ahead to the next part. If you want to see the clip, then it's on my Twitter post. You just scroll down a couple of posts, you can go and see it there. I'm sure a lot of you have seen this already, but I'll play you this clip now and hopefully I won't have to be forced to edit this out.
Do you think that there is a possible recession on the horizon?
Not only is there no possibility of a recession, and again, I live in a world of probabilities of some kind of distribution of outcome. The reason there can't be a recession, again, you have to redefine it. Will the government and the Fed allow there to be a bunch of job losses at some massive level that leads to a credit cycle unwind? It can't happen anymore.
What? Look, as always, I could be wrong, right? Maybe I'm totally wrong about the recession, right? Maybe we're going up only forever. Maybe the government and Fed will not allow a recession. But if you ask me, this is what peak complacency looks like, okay? He seems so sure of himself, so smug, so steadfast, that he both says he's a guy of probabilistic outcomes, and at the same time, there is no chance of a recession, right? To me, this is exactly the kind of sentiment shift I expect to see towards the top. And I know there was some people to come out and say, well, this guy's really smart, this guy's a genius, whatever. But remember, like, IQ is not correlated to your ability to become susceptible to having made a bunch of money and getting complacent, right? At the end of the day, everyone's human. Everyone can be subject to complacency. That's just the reality of life. It doesn't, whether he's a genius or not, doesn't detract from the fact that he has emotions, right? And those emotions can become complacent. So I don't know, maybe you're totally okay with this. Maybe you agree with him. I personally think this is exactly what we'd expect to see into the top of a blow off top with all of those people that are currently the other side of the hard landing trade, right? As I just showed you, almost nobody is positioned for a hard landing here, which means it is actually highly contrarian to be calling for a recession. And I think that makes sense because a lot of people are looking at these cuts and saying, well, these are absolutely bullish, right? These are bullish. We're going to be going up only forever. There's no more 4-year cycle. But I mean, even 2 years ago, I demonstrated, 35K subs. Let's go. Thank you for that. I got distracted. So yeah, all the way back 2 years ago, right? This is 2 years ago. It's only got 700 views, this video. And you can see we're at the lows, right? And at the lows, I was saying, look, we're going to have this blow off top and then this deflationary recession. But in here, people were asking me, well, are rate cuts actually bullish or bearish? Like, I'm really confused. So I answered that question here for you guys. So I'm going to cut a couple of clips out of this old 2-year-old plus video here and show you that context really matters, all right? And then we're going to do a little bit of an update on these charts just to really see at the hard right edge, like, am I right to say this thing is bearish? Because I actually don't think this is a topic for debate. I think there are people that are right and there are people that are wrong. And as ever, it's not really about being right or wrong. It's about staying on the right side of the trade, okay? But oftentimes, we can debate things like, does the yield curve predict recession or do recessions force the yield curve to invert, right? We can debate those kind of things. There's no real way of knowing the answer. But when it comes to are these cuts going to be bearish or bullish, I do believe that to say they are being bullish cuts is simply false, right? So let me play this clip and then I'll let you guys make your own decision. I also got a question. Why are you saying that when they start cutting rates, it's bearish? And can you do a video with data to support this case? So, yep, I certainly can. And here it is. First thing I want to outline is that cutting rates, let's say we start at cutting rates. You can start any one of these, but let's say we start by cutting rates. They will lower the rates until the rates are low. Then they will hold the rates low and leave them there for a while. Eventually, they'll start to raise rates again before pausing and we get a plateau in rates, and then they start to cut them again. And this is the Fed rate hike and cutting cycle. The idea behind all of this is that, of course, cutting rates is, in theory, bullish for stocks. Cutting rates makes money cheaper to borrow, and therefore, when money's cheap to borrow, you will likely take some of it and then go and put it in the stock market and other risk assets. Holding rates at the lows means money is very cheap for a while. So this is usually incredibly bullish for stocks, in theory at least, because whilst money is cheap, again, you will take this cheap money that you can borrow cheaply and put it into equities and risk assets. As we start to raise rates, obviously the inverse becomes true in theory, again, and I'll clear this up in just a second, that as money starts to get more expensive, you're less likely to try to chase risk with it. The pause signals to the market that money is done getting more expensive for a while, and therefore perhaps it's time to start looking to wait for the rates to come down. When money becomes cheap again, then we can start chasing yield all over again, right? That's what simple logic says. However, in reality, the markets actually don't quite work like this. So this is probably where this confusion comes from. And mostly the reason for this is because there are lags. When you make changes to rates, it takes a while for this money to trickle through the system. It takes a while for these interest rates to have an impact to the point where hedge funds and banks and stuff are ready to start loaning. Yes, the rate change overnight essentially, but as with pretty much all economic input, the output lags by quite a while. It's also worth pointing out, just before we move on, that this time really is different, and I will show you that in a minute. And I also want you to keep in mind what you're supposed to do versus what they did. What you're supposed to do is, as we have periods of economic boom, you're supposed to slowly hike the rates whilst the going is good. This is because during periods of economic growth, the economy can withstand small incremental rate hikes. This means that hiking rates shouldn't necessarily be damaging to the economy. And that also means that when rates are sufficiently high that they're starting to inhibit the growth, you can stimulate the economy by cutting rates. This is what you're supposed to do. But remember, what they've actually been doing since that man in the first video has had his reign was the complete opposite. When we had a massive period of economic expansion and a big boom in the stock market, they held rates at zero or negative. And now what they're doing is starting to hike into, or I say starting to, they have been hiking into a slowing economy. So what they have been doing for the last 5, 6, 7 years is actually completely backwards to what they're supposed to do. It's also worth keeping that in mind. If we jump into this chart here, you can see that the shaded areas denote the bear markets here, okay?
The red line is the Wilshire 5000 total market cap index, and the blue line is the Fed funds rate. You can see that again, upon starting to cut the rates, we dive off a cliff. Cut the rates, dive off a cliff. Cut the rates, dive off a cliff. Here particularly, we move to a plateau whilst we put in the final blow off top move. As we start to cut rates, stock market dives off a cliff. Again, see this plateau as we have the final leg up, followed by the pivot to cutting rates, and the market dives off a cliff. The reason I say this time was a bit different is because this was the taper tantrum of 2018. This was bloody October. I remember this is very fresh in my mind. This time was very strange because the Fed started to do the right thing. Whilst we were in a period of economic boom, the Fed started to hike rates. However, the Fed made a critical policy mistake here. And that policy mistake was, as they started to hike rates, the market, through this taper tantrum, the market started to sell off heavily and rapidly, and the Fed folded. The Fed said, oh, whoa, okay, stock market, don't do that, we'll cut the rates again. So they immediately went to cutting rates, all in a very short period of time. And the market said, yeah, thank you very much, Fed. That's what we thought. We're in charge here. So this was a bit of a strange outlier in the data set. And like I say, this was because the Fed actually bowed down to the markets. Again, you can see the S&P 500 bear market shaded in all these pink areas. And again, when we start to cut rates, usually the trigger for the bear market. Start to cut rates, trigger for the bear market. Cutting rates, trigger for the bear market. Same here. Cut rates, bear market, again, is an outlier, as I've said. To illustrate that point further, you can see here that they pivot to cutting rates, and instead the market melts up for a while and then plunges during the pandemic. So I don't really think that you can include this in the data set. Like I said, the Fed bowed to the markets here, which is something the Fed wouldn't ordinarily do. And also, like I said, they are counting this 35% drawdown. But remember, that was the C19 meltdown, the C19 plunge. So for me, this is a bit of a spurious data point. However, going all the way back, you can see they cut the rates, bear market. And again, we get these plateaus leading to the final blow-off move, followed by cutting rates and a meltdown. Plateau again into this final leg up. So historically speaking, cutting rates is bearish. Cutting rates is usually the trigger for the biggest drawdown in the bear market. This is because of that lag I was telling you about at the start of this video. Why would you begin to borrow money here at the start of a cutting cycle when you know for sure if they've started cutting rates, then just being a bit more patient means you could borrow money a lot cheaper? So this speaks somewhat to that lag that we see. Like I said, you wouldn't borrow money up here at the start of a cutting cycle when you know if you just wait a few months, you can borrow it for next to nothing.
Okay, so there is some retro camel, some classic camel, I don't know what you call it, vintage camel, that's what I was looking for. There's some vintage camel for you guys, right? But I did want to add one more thing to this, okay? I wanted to kind of build on this further, because there's one or two times in here, like for example this, where we were cutting rates, okay, and the markets went higher. And I think people like to point at these kind of situations and say, well, there you go, like 50% of the time is bullish, 50% is bearish, whatever. But there's actually a way to screen these rate cuts and the S&P 500 or the stock market performance, right? So that we can point at these and say, well, how do we know which times when we're cutting it's going to be bearish for stocks and which times the market's going to just rally in the face of it, right? And the way you do that is by simply pulling up the 10-2 yield curve, which if you've been on this channel before, you'll be familiar with this right here, okay? And what you'll notice is every single time that these rate cuts were cuts into a slowdown and led to bear markets in the stocks, it happened and occurred against a backdrop of two things. Number one, the inverted yield curve, okay? When the yield curve inverts, goes back below zero, okay, then it reverts and accelerates. We know that this is an alarm signal, and we talk about this every weekend in the weekend's deep dive videos, right? But if you go back and screen, like I said, these sorts of times in here, okay, the yield curve wasn't inverted when we were cutting rates here. And thus, these were not cuts into a slowdown or recession with an inverted yield curve. Instead, these were cuts into normalization, a soft landing, everything is happy days, right? That is the context. That's the way you screen the difference. And you can also do the same thing with the unemployment rate. If the unemployment rate is not spiking, then, of course, it's not recessionary. But at the hard right edge today, everyone is talking about these being super bullish cuts and looking out 12 months, we're going to be, new all-time highs and all this kind of thing again. But just like every other instance of recession, and here's the key part, bear market for the stocks, not only did we have an inverted yield curve, okay, but we've got the labour market deterioration as per the weekend's deep dive videos. We just had 911,000 downward revisions to the jobs, right? Okay, so that is recessionary, which means we can't actually look at this and say, yeah, these are cuts into normalization and a soft landing. I don't think that is the case. I think it's extremely contrarian now to say these are cuts into a hard landing. And whilst I am still calling for higher prices into the end of the year, whilst I still think we can get 1, 2, even 3 cuts, right? We can get September, October, and maybe even December's cut behind us and then rally into the end of the year. I'm pretty sure by January, that's it. It's going to be over. We're going to be heavily into a recession. I mean, so many things have to change. The labor market deterioration, manufacturing, consumer sentiment, purchasing managers index, the yield curve. You know, there's so much that has to be undone here. And that's just the tip of the iceberg, what I've been leaning on. Something else that is worth pointing out too, this is not just any inversion. This is not just any yield curve inversion. This is a record quantity of inversion for a record amount of time. And of course, as we know, we're pretty close now to these 4-year cycle lows for the stocks, for the half cycle low in the 8-year cycle for gold, and of course for Bitcoin. Bitcoin also has a 4-year cycle low, despite a bunch of people wanting to doubt it. So again, as always, right, you can make your own decision. You totally make your own decision. I'm not trying to convince anyone of anything, but I'm just simply making the case that whilst the majority of the market seems to have gotten fed up with the idea of recession, the majority of the market also seems to be thinking that these rate cuts are bullish. And at the same time, we have people making this kind of content. I really hope I wasn't forced to edit this out. And we have this kind of, there's zero probability of a recession, right? I mean, and this whole idea of the Fed or the government or Trump or even Elon won't allow it. I actually see some people saying Elon is going to step in. And I mean, I don't know what planet you're living on, okay? But the idea that any individuals, entities, governments can prevent things like a global deflationary deleveraging is crazy, right? It's just not how the real world works. And people say, well, you can just throw money at it, right? But they're already clear. They're way too concerned about the current levels of inflation. They're not just going to pivot to printing because, quote, they can't allow a drawdown, right? This to me seems absurd, but it's exactly the kind of absurdity that we tend to see towards major tops. And I remember back here, right into the top of MicroStrategy, people were saying absurd things then. They were saying, Camel, your TA doesn't apply on this one stock, right? I know your TA and cycles work on everything else, but it's not going to work on MicroStrategy. That's absurd. That's a ridiculous thing to say, right? People were also saying, oh, you don't understand that there's never been a stock like this, right? Which that might be true, but guess what? It behaved exactly like any other fourth angle violation, parabolic blow off top, right? And we've even seen this exact structure right here in the prior cycle. So nothing was actually different about this. But I remember making dozens of videos around here saying, look, it feels really horrible here. Even as a contrarian, a legit contrarian that actually really despises normality and herds of people and all this kind of thing, right? But even here, I was quite uncomfortable because there was a queue 2 blocks long to lynch me the moment I was wrong about this call, right? People were being threatening and personal back here because a man sold a position after capturing it from the lows, right? Like, that's the level of absurdity that occurred right here. And I make the case that this is pretty much the exact same thing, right? Humans don't change. They do the same stuff over and over again, just like this dumbass camel keeps making the same videos over and over again, hoping that someone somewhere will be like, oh yeah, maybe this guy has a point. Maybe I should at least consider this as one possible outcome. I'm not suggesting you should abandon all other theses and that I am omnipotent, omniscient, and I have all the answers. I'm not suggesting that, but I'm just saying the way I look around at these markets, and I've been doing this for a bloody long time, it's all I do. And the way I look around at the moment, this just absolutely reeks of a top. The market's one-sided. Everyone's cheering on these bullish rate cuts into next year. And I think I've seen this before. I think I know what happens, right? They are going to let us go home for Christmas at record highs, having fantastic conversations about how we've all never been richer and fuller and fatter. And then you're going to show up to work on Monday morning in January or whatever the day is, right? And everything's going to come tumbling down. And then finally, I'm going to be going, I try to tell you, right? I try to tell you that this was a possibility. It's not just a possibility. I think it's a very strong possibility. Meanwhile, there's people here telling you that the Fed's just not going to allow it, right? I don't know, man. This stuff makes me increasingly nervous the more I'm kind of looking around. That doesn't mean I'm going to be trading like a nervous Nelly. Doesn't mean I let the nerves get in the way of the actual system or I deviate from the system in any way. It's the same stuff as always, right? It's business as usual here on this channel. But if you think this is okay, then that is just a level of understanding that I am never going to attain. I know a bunch of people are not really caring about this stuff and they just want the short term, right? What's Bitcoin going to do out of FOMC? And again, no one really knows. But the heat maps are looking like we could have a little flush and then we could have a big pump. And the moment we get that pump and we break out above level 4, every other prior level breakout has seen us push straight up to the following level. So that for us is north of 180k, right? Seems reasonable. In the short term, we got some Elliott wave counts suggesting that we might have to have a little puke here for Ethereum and then off to Valhalla. The Camel Finance indicator is supporting this as well, right? A little puke after FOMC, flush out some cycles, and then it should be time to go again. I'm looking at Bitcoin here, refusing to give up its current daily count, isn't it? Let's go back to the daily time frame. I mean, it's refusing to give this up, isn't it? So far, I mean, it seems like the camel count, the indicator count, my count, whatever you want to call it, is all correct and is going in the right direction. So again, happy days there. I'm seeing a bunch of people start to get nervous about gold, but you know, for now, long and strong, we'll see what happens. And the stock market, you know, is really due a nice correction into both a daily and a weekly cycle. We should be about to kind of see that, and FOMC could easily be the catalyst, but so far it's just relentlessly and ruthlessly strong, isn't it? So again, the markets are not the economy. I am extremely bullish into the end of the year. I expect to be adding even more positions. I expect to be cashing in a bunch of profit, and I expect to be saying things like long and strong continue to push over and over and over again until we get to kind of November, December timeframe. In the very short term, I am looking for some cycle lows kind of in that early October timeframe for the stocks and perhaps even Bitcoin, subject to whether or not Bob Lucas's count turns out to be correct. Obviously, if this thing blasts straight off to new highs, then we can't possibly say that Bob's count was correct. It has to be this one, but it's definitely susceptible to a rollover here into that October timeframe. And as I keep saying, I would actually rather see that, get the weekly cycle behind us, and then that gives us a good 2 to 3 months of upside out of that new weekly cycle. So, I mean, again, you know, super bullish. I'm so bullish. I don't think there's that many people that are legitimately calling for 200k, but I am one of those people, right? I'm one of those people that says I don't think we can discount that. I'm still one of these people that is extremely bullish the precious metals, 50, 60 plus dollars for silver and gold. I think we can make at least 4,400 at least, right? I think that would be kind of like the conservative side of the upside here, but who knows really, right? Who knows? I think the stock market's probably not even close to done. I think it's probably got this kind of weekly cycle low, like I said, and then one final big left translated weekly cycle blow off top moment. How high that goes is anybody's guess, but I expect to be loading up on more stuff out of this weekly cycle low too, since it's ultra high probability and it's a clean area on the chart for invalidation and to manage the risk around as always. So, you know, I'm super bullish, right? I've been jumping up and down, screaming blow off top for like nearly 3 years now, you know, but at the same time, like, I think it is kind of silly to look at the under the hood stuff and the recession and the jobs data and the fact the Fed's behind the curve and that we're only getting 25 basis points at the moment and all of that kind of thing, and say that recession risk is not really there at the moment. So as always, like, this is just the way I see it. I just share it with you guys and you can take it or leave it. It's entirely up to you. Let me know if you want to do a live stream tomorrow. We'll come back and do that. Otherwise, sit tight, and I'm your boy Camel. Until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game.